Thank you. Good afternoon. Calima, oil and gas company which owns and operates 72,000 acres of drilling rights in the Montney in British Columbia. And after a very successful drilling campaign earlier in the year, and there's 2 of our wells being tested, we now have independently assessed contingent and prospective resources of some 3 trillion cubic feet of gas and 160 million barrels of condensate and natural gas liquids. Board and management team who bring together a great combination of both geoscience and corporate experience. It's not our first rodeo. We've built a lot of successful teams together. And a little bit about the Montney. It's a very prolific oil and gas play. It's the fastest growing oil and gas play in Canada by some considerable distance. Back in 2014, they assessed the reserves here at 450 trillion cubic feet of gas and 14 billion barrels of condensate. And yet, it's only the same size as Tasmania. It gives you some idea of how prolific it is. And to put it in context, I mean, Australia, which is a gas powerhouse in the global market, only has about 250 TCF of gas. So about half of what you get in the Montney. And we've established a position up in the northern part of the play within the overpressured gas, wet gas or oil window. So it's the liquids that drive the economics. Our drilling earlier this year, this all started back in 2014 when we did some mapping that predicted that the northern bit of this play was going to be particularly rich in liquids. So since 2014, we've built our land position, and earlier this year we drilled the wells, and I'm delighted to say that the mapping was correct. Our predictions were correct. The drilling results we got were quite extraordinary. It's in the top quartile of all our peer group. We flowed gas at over 10 million cubic feet a day, and the liquids rate was climbing up through 40 barrels per million cubic feet as the well was cleaning up and was getting larger and larger. We had an independent assessment of that drilling campaign done, and you can see some little quotes on that slide. That the Calima well is likely to exceed the performance of adjacent wells, both in terms of overall production performance, such as the gas production rate, and in terms of the liquid yield. So quite exciting results when you consider that the Montney is one of the most prolific resource plays in all of North America. And that resource update, that resource statement summarized there in red, you can see the area around our wells where we have the contingent resource. And in green is the slightly lower category of prospective resource. But in total there, as I said, some 3 trillion cubic feet of gas and 160 million barrels of condensate and natural gas liquids. And of that 160 million barrels, we would expect between 60 and 70%, let's say, to be condensate. And condensate gets pricing at or close to the same level as WTI. So really, it's an oil play. And that's what drives the economics. So set against all that, we need to look at our share price. And here's our share price relative on the left to some of the ASX indices, and on the right relative to a peer group of other ASX companies investing in North America. So here we have a situation where the drilling has exceeded our expectations. We've got top quartile production performance. We've had a significant increase in our resource numbers. It's rich in condensate, so we get oil pricing. We've got a world-class resource play here in one of the world's most prolific basins. And so that share price performance does require some explanation, and it is deeply frustrating. Well, I'm glad you all find it funny. I don't. That wasn't meant to be a joke. I don't get a laugh at that part. Okay, but let's look at it in the Canadian context. And on the left, we're comparing, along the top there, some of the ASX indices, and then you go down in light blue is the TSX, the Canadian oil and gas index, and then in dark blue, the TSV, the venture market in Canada, which is where most small cap oil and gas companies are. And you can see that there's a divergence there in performance. And in particular, and if we compare ourselves against our Montney peer group of E&P companies, you can see that unfortunately all we've done is that we've tracked our peer group. And the Canadian E&P equity market is sitting at a 20-year low right now. The M&A market is at a 30-year low in the first half of this year. So quite challenging times, caused in part by Canada's success, and its rapid increase in production has overwhelmed its pipeline capacity to get the product out to market. And the Americans are exploiting that. In fact, there's an infrastructure war going on, and the Canadians hadn't even realized that war had been declared. They were getting the raw end of the stick, shall we say, to be polite. So it's cold comfort for us, but we have in fact performed along with our peer group. So what happens next? Well, fortunately, the Canadians have woken up to the fact that there's a resource war underway. In the red bubbles there on the left, you can see the scale of the resource in Canada compared to the US, and it's very, very significant indeed. And you're starting to see in the public, commentary, both in the media and on social media, if you believe that bit, the realization, right? Lack of pipeline capacity last year cost Canada $2.35 million per hour. This is now becoming mainstream comment. Exporting product, both gas and oil, from Canada into the US at a deep discount. And so we've seen rail cars of Canadian crude traveling across the border into the US, down to the Gulf Coast, where it is sold at market rates, not a discount rate, and shipped off to Asia. And not surprisingly, it is the companies that control those transportation networks that are funding all the opposition groups that are stopping infrastructure development in Canada. Well, pleased to say that people are waking up to this. And in fact, there's an election, the federal election in Canada next week, could be a bit of a catalyst here, because there does need to be stronger government policy and decision-making about how to develop their resource. But fortunately, we don't have to rely on politics. I'd be a foolish man to do that. The fundamentals of supply and demand in Canada actually are becoming quite interesting. You see there on the right, gas supply and demand, and what you can see is a number of new projects coming on. At the moment, the Montney alone produces 7 billion cubic feet of gas a day and 400,000 barrels of condensate. But over the next 7 years, there's 12 to 15 billion cubic feet per day of new demand coming into the market, principally from LNG. Shell and Petronas and their partners building LNG at Kitimat, and also Chevron and Woodside building LNG at Kitimat. And what the map on the left is showing you is that actually our project sits right next door to those pipelines. And if you believe the analysis that's being talked about quite a bit in Canada at the moment, we're sitting at a really interesting point, just ahead of the point where the production that had overwhelmed the pipeline capacity is about to switch. As new pipelines are brought in over the next 12 to 18 months, you're going to see the switch from being short of export capacity to being long on export capacity. So that's going to be a fundamental switch in the basin. And as regards the condensate down in the bottom right, Alberta in particularly is massively structurally short of condensate. for the heavy oil play where it's used as a diluent. And that's why you get WTI pricing. And that structural short is going to continue for quite some time. So the condensate demand is as strong as it ever was, and we're about to see a really interesting switch in gas demand. And that's before the LNG projects come into play. So what happens when you open up a basin to infrastructure? We have a very nice example from the Marcellus in the US. And in red, you see the price of Marcellus gas expressed in the Dominion South price versus Henry Hub in blue. And as that basin opened up, exactly the same thing happened. The production overwhelmed the capacity of the pipelines to take the gas away. Marcellus gas was selling at a steep discount to Henry Hub. Then what happened in 2017 and 18, new infrastructure was brought into the basin, and you see what happens to the price, an immediate adjustment. The discount disappears. And then on the left, you can see the Montney Western Canadian benchmark price, AECO in blue against Henry Hub in grey. You can see the same thing, the discount. Interestingly, that discount is narrowing, which is what's predicted by the chart we looked at previously. We're going to hit that interesting switch point. So what will happen then is we expect the discount to Henry Hub to disappear, and because we're sitting in one of the most prolific basins in North America, if you get Henry Hub pricing for your gas, this basin flies. So we're about to get to a very interesting point. And what happens when you open up a basin to LNG for the first time? Now this is, we've got an analogy here that's closer to home. And those of you who remember this, once in a generation lifetime to create wealth, as LNG opened up the basin in Queensland and the resource owners there saw an extraordinary increase in valuation. So we're about to see these LNG projects come in on the west coast of Canada, and I'll just remind you that you can produce LNG for about 50% of the cost that you can in Australia, and the carbon footprint is less than half that of Australia because it's powered by hydro. So it's a very clean project. And in fact, Canada, by exporting LNG from the west coast into Asia, where it's displacing coal for power generation, can earn carbon credits. Very important in today's ESG world. So where do we sit in all that? I mean, it's a compelling macro picture. Despite the headwinds today, and we think we're about to see a very strong recovery in the Canadian energy market, well, we're sitting in a great place. We have a huge resource. We have infrastructure available to us to the north that is underused so that we can use that infrastructure and minimize our capex. So you can think of us as an option play on that whole Canadian LNG industry and energy market recovery. Because remember, we're sitting close to the pipes that will feed those LNG projects. That infrastructure to the north of us can handle about 50 million cubic feet of air and about 2,000 to 2,500 barrels of condensate. Well, if we ran that pilot project for 8 years, it would only touch about 5% of our resource base, barely touch the sides. So there's plenty of scope there. That's a project because of the capital cost advantages that will run at today's prices. And as this macro thematic plays out, remembering that we're barely touching the sides of the resource base with that, we can expand into that market. So the path forward to us, we have a number of milestones internally that we're working on, and it's all to do with putting in place the building blocks of our development. And it's to do with road and pipeline access. Need to get approval for our tie-in pipeline, pad facilities, gas processing agreements, offtake agreements, resource booking, and of course a debt finance facility. It's all the steps we take, and it might not be dramatic, it might not be exciting, but it's the thing that creates the value. Now, outside of that, we have some external catalysts, things like the election results coming up, Calima LNG taking FID, that's the Chevron Woodside project, LNG Canada taking FID on stage 2, and various other pipeline things going on. Now, you might think that some of those external catalysts aren't strictly relevant, but if we could look back to 2018, and it's the point where, and if you excuse me, I'm going to point, because the green bit we can't see, is It's there where the equity market turned and started to go nicely upwards. All to do with external catalysts. It was Shell talking about FID on the LNG, and it was some pipeline approvals. So the M&A market opened up and assets were changing hands between $3,000 to $5,000 an acre. So those external catalysts have a huge impact on sentiment. And given that the Canadian market is sitting at 20-year lows, a strong recovery is in prospect. And to put it in context, our acreage today in the market is being valued at less than $300 an acre. So there's a lot of scope for growth there. So in conclusion, we did our mapping, we made a prediction about an area that we thought was going to be liquids rich. We've now built the land position, we've drilled it, we've proved our hunch to be correct. The timing is frustrating as the Canadian market goes through a super low, but these things are cyclical and we know what happens in cycles. And we've positioned ourselves really well to come out of that cycle. What we're doing at the moment is we're building. We're putting the building blocks in place of a field development plan which would come on in its pilot stage at around 10,000 barrels of oil equivalent per day. So going forward, you have a wonderful option play here on the LNG opening up this basin and on the recovery in the Canadian energy sector, all underpinned by the ongoing strength for condensate demand. So we're in a great place here to play the cycle, and we're ready to start a process to go out there and bring in strategic partners and joint venture partners to move this on and to shift our valuation from where it is today at less than $300 an acre and be ready for when the next M&A window opens and assets start changing hands again. Ladies and gentlemen, thank you very much indeed.